Good afternoon. How is everybody doing? Welcome to Curated Legacies, episode 10. 10.
10.
10. And for those of you who may not know me, I am one of the co hosts here. My name is RJ, and I help motivated investors take the money that they've earned and create more revenue. And my co host, well, it's Prill.
Yes, hello, I'm Apryl, and full-time and part-time entrepreneurs turn to me when they are feeling overwhelmed, overworked, and headed towards burnout.
Okay, again,
Mhm.
she's always on infomercial mode.
Whatever.
You always make it sound so great. I swear it gets fancier and fancier each week. You must practice.
Whatever. Yeah. So
Yeah.
what? So this is episode 10. As you mentioned, I'm really excited about today's guest. But can we just talk about last week, really
Yeah.
quick? The people pleasing. Whew.
Yes. We talked about, are you a people pleaser? Now, before we get into that, remember, guys, if you've missed any of our conversations, that, like I just said, we are on episode 10. We want to personally invite you to go back. And if you got any questions, if you got any value, if we stepped on your toes, or if you just simply want to just join the conversation, leave it in the comments. But if you
Yeah.
missed last week, we talked about, are you a people pleaser? We shared
Hmm.
that it can show up in different places: work, school, church, home. We unpacked it.
Yeah, it
We-
was really good. Yeah, it was really good. And just, a reminder to those of you who watch and who tuned in, like, look, as we mentioned, yes, there's some things that that we've made it over, so to speak. But there's some things that are continual. And just it was nice to be able to just bring you guys in and just kind of share that because it's really important. Imposter syndrome, people pleasing, those are some things I think that can really set folks free. But nonetheless, anyway, we have company today. So and we're
yeah.
switched. You notice that? We're switched.
Let's see if I can.
Yeah, okay. So do you see
There we
how
go.
she did that? I didn't have to say anything because me saying we're switched, she knows like that's gonna bother me. So she just changed it.
I kept looking at it. I'm like, something is off. Anyway,
We're switched. Yeah. Okay. Now all's right with the world. So that's I'm super excited about today's guest. Let me go ahead and quit flapping these gums and let you go ahead and
so
introduce
I
her. I'm
got
so
you.
excited.
No, so okay, so we're going to shift gears a little bit this
Yeah.
today. Like she said, we talked about, are you a pleaser, a people pleaser last week. Now I know according to the calendar, we have passed financial literacy month, right? But we think that it's befitting to actually keep that conversation going because it should
Yes.
be an ongoing process. You should always want to learn more about your finances and how does it work and what should you and should you not be doing. So
Yeah.
today we got a special guest. She's going to share with us how to position your money. But before we bring on our guest, because we got company, Pro, like you
That's
said,
right.
company,
That's right. Hmm.
I just want to give her a proper, invitation on the stage. But so let's read her bio.
Yes.
So Shatika Husser is a multi-dimensional investor, life insurance broker in 16 states with a team in all 50. She's a retirement consultant and a transition coach. Her mission is to help professionals move from a chaos to career to calling and retire before they expire with infinite
Yes.
tax-free retirement income they will not outlive. Oh, I'm loving this already.
Right.
She is the founder of the Winning in Wealth Faith Based Club and an international best-selling author of Reckless Abandonment,
Mm.
Becoming Free of God's Purpose, and has authored financial literacy community events and Winning in Wealth radio shows. So, Pearl, join me and everybody else in welcoming Shatika Husser to Curate.
Yes. Hello.
Hello, everyone. Good to see you. Can you hear me?
Yes.
Woo!
Yes, we can hear you just fine. Yes.
Awesome. Awesome.
Welcome.
Yes, it's great to be here. Thank you so much for having me on the show. I'm excited to share a few, tidbits and gems and all that good stuff with you guys. So we can go ahead and do what we got to do and help people with that retirement planning.
Good.
Yes.
All right, so let's just jump right into it.
Okay. So we have the slide there.
So, Pearl, a lot of people don't realize that, you hear in the calendar about financial literacy, it's just 1 month. And I really don't know why that's the message
No.
that we're conveying, because this is
Yeah.
something to be ongoing on a
Yeah.
regular basis.
Yeah.
Yeah.
Something for every day, and especially during this day and age. And you know me, I read the Consumer Price Index in my spare time. So this is something that is that I've been observing, especially living in Phoenix. Our inflation is really high here, and so I think this is just a timely conversation. And you know, like we do on here, we want to continue these conversations 365, not
Right.
just during 30, 31 days during a month. Okay, are
Exactly.
you ready? Because you
I
know
am
how we
ready.
do over here.
So
Okay.
I do have the slide up. Do you see the slide?
Yes.
Yes, we can
Perfect,
see
perfect.
it.
So we're going to
Mhm.
jump right in just to introduce myself. I do appreciate that warm introduction, but I am Shatika Husser, CEO of Husser Financial Solutions. So we are helping you retire before you expire. As she mentioned, our goal really is to get your bank account on fire with a whole lot of lifetime tax-free retirement income that you will not outlive. So the route to retirement is really what this conversation is about today, and how to become your bank and position your money for infinite. Somebody say infinite.
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 Tax-free income. That's what we're talking about, the never-ending solution. So we are going to cover a few things, but we're going to go right into who we are and what we do. So we are powered by First Financial Security, a national brokerage firm out of Atlanta, Georgia. Our mission really is to help people achieve financial security and peace of mind. And of course, we are headquartered out of New Jersey, and our financial strategies, retirement planning, life insurance, and debt solutions is what we provide for our clients. Now, again, how to position your money for a tax-free retirement income with forever distribution is what we are talking about today. How we are organized, Hustle Financial Solutions, now Shatika Hustle Financial Services, is partnered with First Financial Security. We have carriers that we partner with to make sure that our clients are taken care of with the contracts, and making sure that they understand what the contracts mean, and making sure that it's going to help suit them in terms of their vision for retirement. Now, if I was to ask you, how do you feel about your retirement plan? Do you feel like your retirement plan is going to do what you need it to do in the future? Most people are not confident. So there's just a few questions here to kind of ponder when you start considering your retirement account and what that should look like. Like, how will I create a supplemental income for later in life? How can I ensure I will not outlive my savings? How near or past retirement age am I right now? What are the tax implications of my current plan? How can I create a guaranteed lifetime income? Do I have term life insurance that is expiring soon? Super important one. Is my money 100% protected from market volatility? Will my current plan be able to keep up with the cost of inflation? Can my retirement plan withstand a market correction, meaning what we're going through right now with the market crashing, and it's going to continue to correct? Is my retirement 100% protected from lawsuits, including divorce for some people? That has that as a concern. Does my plan have medical benefits built in it? These are all valid concerns that people have for their retirement account. And of course, a retirement ready account is going to do at least these 6 things, but there's actually 11 different things that I often mention when I'm having these conversations. So if you retire today, would you be able to maintain your current lifestyle is the question. Of course, there's a math equation that most people will come out with, saying that, 80% of whatever you make today times 20 to 30 years, because of medical technology, people are living a lot longer. So that number is closer to 30 years of retirement than it is 20. So for easy math, let's say if you're making $100,000 and you did 80% of that, $80,000, and you only live 20 years, that's $1.6 million. But let's say we're going to factor in inflation. So you're closer to 90%, in some cases 100% of that $100,000 because of inflation. So to use a more realistic number, you at least want to start around $90,000. And let's say you're going to live a long life because of your health situation, 30 years, 90, right? $1,000 times 30 years, $2.7 million. That's a big difference. So where we once were with retirement versus where we are today, this problem is becoming larger because of inflation and living longer. The biggest fear besides, dying is going to be, can I have enough money stored away to be able to have in retirement, right? So am I going to outlive my retirement, or am I going to run out of money is the biggest question that people have. So that's the reason why we do it. We do want to make sure people understand the options that they have. The first thing let's talk about, and let's just agree on this. Can we just agree that there's 3 different options for your money? Number one, your money could either be fixed, it could either be a variable going up and down, or it can be an index, meaning that when the market goes down, as you can see, your money is locked in at its most highest peak, okay? And it never goes down, it never dips, it just locks into place. And when the market returns, you're still at that same position. You didn't lose any money. And then when the market goes up, you participate again. Okay. That's that second lock that you see. So every time the market goes up, you go up. Your account increases. Your account is credited with more money versus you losing money. So index is the way to go. And you may be hearing people say that index universal life policies. You might have heard of that. You might have heard of index annuity. The reason why it's index is because you only participate in the market when the market goes up. You do not participate when it goes down, meaning that you can only grow. You cannot lose. And of course, Warren Buffett's rule number 1 and Warren Buffett's rule number 2 is to never lose money. So what other ways could you look to do that besides an index product? All right. So let's just agree on that fact first. But what if there's a way to have safety of principal, upside potential, meaning that you can, like we just talked about, participate in the market when the market goes up, your account is credited and it is growing for you. That's an index product, meaning you have the best of both worlds. Today, we're going to talk about a tale of 2 brothers really quickly, because this is the biggest scenario that I'm seeing with most people today is a mindset. Can somebody just say mindset?
Mindset.
We have to unlearn what we once learned when it comes to traditional retirement and how we fund, right? So brother A is who I once was. And this is why I do what I do all day, every day. This is why I have the passion to do this, because of brother A and who I once was. When you know better, you do better. So brother A is traditional, right? He's doing a 401k. For some people, that's a 457. It's a 403B. It's a 414 TSP for the government employees, IRA, Roth IRA. It's all those accounts. Anything that starts with a 4, TSP and IRA, basically, right? Those are all what we call qualified accounts, meaning that you're qualified to have to pay taxes. Rather, you're going to pay taxes in the beginning with a Roth or pay taxes later with everything else. All right. So brother A is traditional. Now let's look at this. Both of these gentlemen are brothers. They're both age 35, married with 2 children, have 8% interest rate, have the same amount of money for the same period of time. We're just going to see what happens to their money. Brother A, of course, as you see here, with a traditional retirement account, has $6,500. His employer is matching him at a little over $1,000. He has a 30-year term policy that we know is like a rented insurance, because it's going to leave when he leave and retire, right? In most cases. Brother B, on the other hand, he understands the new way. He has unlearned the old way. He now understands that the retirement ready account that we just mentioned is going to be something similar to an IUL, where he's going to have a $7,200 annual premium. And then he's going to basically he's going to have $600,000, just like brother A. But the difference is, instead of his expiring, he will have this for his entire life, if he lives to be 100 or 120 years old. Who made the right decision? No one knows yet. Not enough information. We get that. But the goal here is to see that you have a taxable account qualified to the left, and then you have a tax-free account on the right, the new way. So if I could tell you again what Warren Buffett says is to never lose money, you want to try to keep more money in your account so that you can have more money to live off of later. So results after 30 years, brother A ends up with $858,000. Brother B ends up with $709,000, slightly behind, right? But how many of you know it's not how much you make, but how much you keep? We're still talking about that. So brother A ends up with the term, but guess what? Is a balloon now, especially for the government employees of today. They learn it when it's too late, that they have a balloon payment in terms of what they have to end up paying for their insurance. That is especially that group, any government employee, especially, right? And then so $12,000 is his annual premium now, because he's older. He's probably not as healthy for that same insurance he had with his employer when he was once employed. $65,000, of course, in deferred taxes. So he has his $858,000. Brother B, on the other hand, he has the IUL. he has a death benefit of $864,000 that he gets to leverage. And that's a key word, somebody, leverage, because we're going to talk about that. But he's paying absolutely no taxes. So even though he's slightly behind, no taxes to have to pay. What happens during retirement? Brother B and brother A. I didn't even like hype you up. Brother B ends up with $97,000, all right, in annual income every single year until he dies. Let's say he dies at age 100. He ends up with an income of, close to what he had when he was at 35 years old, when he was younger, because he started putting away money at a young age he positioned his money, like we're talking about, into the different type of account. Now, I know somebody out there may be saying, oh, I don't know if I had the health for that. We're going to talk about that later on in this presentation, because not everybody may qualify because of their health, right? But he ends up leaving his family almost $3.4 million if he ends up doing an IUL plan, and he can live off of a $3 million account, where what I'm seeing, which is an epidemic all day long, all the time, people are running out of money in 9 years after they retire because they have taxes, they have fees, and they have the market that could absolutely halve your account just like that. Some people are losing 50%, 10%, 30% because of the market volatility. So between those three things, what do you have left to live off? And then whatever you have left, how many years do you have? There's no leverage. There's no leverage for that amount of money. So his $858,000, by the time you take out the taxes, by the time you take out, him, living off of it for 9 years, he is absolutely out of money. Will have to end up back at work at 74 years old if he doesn't have another plan in place. So this is the reason why we have these conversations, to make sure people at least understand what those traditional accounts are going to do for you. They're 30% to 50% higher in fees. There's a Department of Labor handbook that if you're taking notes, the Department of Labor handbook will definitely show you what those fees are. I usually give those out to clients as well, so they can see clearly what the fees are. All right. And, after the fees, after the taxes, after that, hopefully, there's no issue with the market. And the thing about the market losing is, will you have enough time in your lifetime to see it rebound to where it once was? So which plan makes you feel more financially secure? This is what I often ask people, right? So taxes have been as high as 94 and 91% in history. Do you feel like taxes are going to go up where we are in the economy today? Now, something you have to really consider, what type of tax advantage do I want to have? Now, I am not a tax professional by no means. I'm not giving tax advice, but you have to consider your taxes in your equation when it comes to retirement. You can only get 2 out of the 3. And have you considered is the question. Tax-free options. I just gave you the tax-free option. Now, the red line that you see here is your traditional, IRA, Roth IRA, every account, every employer type of account is that red line. It is whatever the market is doing is exactly what's going to happen. And I'm just showing you real life, from the 1997 to just 2018, how people have been able to leverage index products, which is the blue line. They've been able to leverage based on the fact that when the market went down back in 2000 and 2001, they didn't dip in their accounts. The same thing happened in 2007 and 2008. They never dipped. For that same $100,000, they would have lost about, over almost $60,000 twice, literally in this challenge where you're seeing where the money was actually going down with it. So the problem is, how can you make sure that you have the right diversification of your portfolio? Nothing wrong with having diversification, but the older you become, the less risk tolerant you should be, because you want to make sure that you have enough money for retirement and you have predictability in terms of what you're going to have in retirement. All right. So right now we're in a market correction, because as you can see, the market has been going up, all these years, right? Since 2009 to now, pretty much the market's been going up. Now we're in a market correction and people are all over the place. They're just like flabbergasted by the amount of money they're losing on these accounts. No one had this conversation with them, or maybe they didn't seek out the information, but when you know better, you do better. So the goal is to meet with people at their earliest, at the earliest point of life so that they can do something about it. Now, what if I told you there was a way to stop the market losses in your retirement account and receive income for the rest of your life? Again, on the left side, these are your traditional accounts, everything that we mentioned earlier, everything, right? But there's something called the index annuity. The index annuity is popular right now for people that cannot get the insurance, right? Because of maybe their health. You can get an annuity though, and it still will cover you for wellness riders and things of that nature. We're going to talk about that. Depending on what type of annuity you receive, you could actually receive a bonus of anywhere from 4 to 10%, depending on which state you're in and depending on the carrier. Let's say you have a growth annuity. There's carriers out here that's doing annuities up to 285% participation rate. I want to break that down. Our participation rate is basically the percent multiplied of whatever the economy is doing. So for example, if the economy is doing 10%, if the S&P 500 is doing 10%, then you would do 285% of that in your account, right? In other words, 28.5% versus a 10% will be credited to your account. So we have carriers that's doing that. I often tell clients, make sure if you're doing your homework that you understand that some of the, we're going to get into IULs, but IULs, there's some anywhere from 66% to 115% participation rate. And then for the index annuity, it's anywhere from about 100% to what I just told you, 285%. And just a few months ago, it was 220%. So when we ask the question about, can my money keep up with inflation? If you have your money in an annuity all day long, absolutely. But guess what? In the last 90 days, it went from 220 to 265 to now 285. And it just keeps going up. We don't know how long, but is a snapshot in time that the carriers are doing this particular carrier that we work with, and at some point it's going to come back down, of course, but it wants to keep in pace with inflation in terms of how its participation rate is going to credit your account. So always understand that, at least that number, along with the cap number for whatever you have when it comes to whatever type of account that you have. What is the participation? How is it going to be credited? That's the question you have to be asking your advisor that you're working with. So the lifetime income benefit rider is something that's attached to the index annuity. Unlike, your traditional retirement account, you can actually have access to what's called a LIBR, L-I-B-R, lifetime income benefit rider, which can actually start as young as 50 years old. People say, I don't want to work till I'm 65. Well, you don't have to if you have enough money. We have clients that make over $1 million or $1 million, and they're living off 10% of that each year, right? Or, that's what they're doing. So at the end of the day, building up this account, you have access to, there is some liquidity of this account, right? Where you don't have any liquidity of your account to the left. Anything that's overhead to the left, yes, you might take a loan out, but you're not going to have access to that money if you decide you no longer want to work for that employer. It's going to be like they call the loan immediately. You're going to have to pay all that back if you take a loan out, if you end up stop working for that employer. And it's going to be double. Right? Because now everything is going to be like all the taxes, everything, because you decided to take a loan out and you no longer work with that employer. So it's really chaotic if that happens and you have a loan in those types of accounts. But on the right-hand side with your index annuity, it is not as liquid. It's not liquid in terms of you accessing that money before the first 10 years, because it's going to be a lot of fees, right? In the first 10 years. But after that, you can start seeing all of that money start to pour in terms of how it's growing, because your money is being credited. It's being credited from day one, but your surrender charge is what you have to consider for the first 10 years of an annuity. That's why some people don't like annuities, because it wasn't explained to them that in the first 10 years, there's going to be a significant fee. The longer you wait, the less the fee is. So year one, it's like 80% or something, high. And this comes down every year for 10 years. And after 10 years, you can have full access to your money that has been growing inside that account. Okay. So be really clear about the index annuity. And that is why some people has given it a bad name, because they didn't explain that and how it actually works. So surrender charge, understanding what that is with an annuity, not putting in money inside of an annuity that you're going to lead in less than 10 years is going to be something to really consider. So absolutely. So lifetime income benefit rider, like I said, you can access up to 10% of your account at the age of 50 and until you're actually ready to retire. If you're ready to retire at 65, then that's fine, or 62. The thing about the index annuity is that the index annuity is just like Social Security. Social Security is an annuity. Let's be clear. All right. But now you are able to design your own Social Security. Economists are saying that Social Security will no longer be around in 2025. If that be the case, what do you have saved? at 2025 and beyond, if that be the case. So that's why we're having these conversations. Super important, because again, you still have to live regardless of whether Social Security is around or not. So this is how you can design your own Social Security plan. But this one has a bonus because it has, the wellness plan in here that we're going to get to. It has lifetime income benefit that you're going to have, right? And then you're going to have the opportunity to have the wellness rider. Wait a minute, let me see. So the wellness rider is something that's going to be able to allow you to have access to your. So if, let's say you have an income annuity and you have a certain income that's coming to you over the rest of your life. Well, if you can't use two of your activities of daily living, you can't walk, bathe yourself, things of that nature, then you can actually double your income for up to 5 years, if that be the case, right? Long-term care needs and things of that nature, you can access your annuity to do what you need done in terms of the income. If you have an income annuity, because there's two types. There's an income annuity, then it's more of a growth annuity. You have to choose which one at the beginning that you would like, of course. But there's all upside gain and no losses. That's the number one reason why people move their money from the traditional retirement account into an index annuity. They are tired of losing money. I have people all the time. They are tired of losing money. And what they do is they move the money into the annuity. They lock it in place. And only thing it can do is just grow. Just like Warren Buffett says, stop losing money. So that's what the index annuity does for you. And that's the reason why billionaires are using it. Okay. And multi-millionaires use this. All right. So it is there for the individual that wants safety of their principal, but wants aggressive growth or just wants to have an income for the rest of their life. And everything to the left, you can primarily move it to an annuity. Annuity can also be a Roth annuity, but it's just how you fund it. It has to be funded a certain way in accordance with the guidelines by the IRS to make sure that it's a Roth annuity, so that way you don't pay taxes. But it is a tax deferred account, unlike the IUL. That's why the IUL is more attractive, because it's growing tax free. And an index annuity, unless you design it as a Roth annuity in the beginning, it will be taxed when you take the money out as well. I did an illustration on someone that puts $100,000 in an annuity. And if that individual puts $100,000 in that annuity and leaves it in there for 17 years, she will be a millionaire. And she never touched that $100,000 at a 285% participation rate. Okay, so that's why we're talking about significant growth here with big dollars. But you have to have the discipline to not touch the money, which most people, they want to touch their money. So that's why an index annuity is not for the individual that wants to use their money within 10 years. All right. So we're going to move on. What kind of life insurance did you have? Right. So this is just a supplemental savings alternative to retirement. So we often talk about tax-free income and all this. And so when you hear that, people are primarily talking about some type of permanent product. And and most people like the IUL because of how it grows over time. It is not for someone that is elderly if they're looking primarily for cash value. It's more so for someone that's starting at a certain age and they want a certain amount of cash value. But you have to begin with the end in mind, like Stephen Covey says, right? So we have to know what kind of income do you want to see in the beginning. So everything to the left, as you can see here, is your traditional life policy. You have your term, you have your whole life, you have your universal life, your variable universal life, and it is explained in purple pretty much what they do, right? So the term is just that. It is temporary. It will normally not be paid out. So there's only 1 to 3% that will actually receive a payout on a term policy. Okay, so 97 to 99% of people will only donate money to the insurance carrier because they have a term policy, because they will never use it. There will be no return on investment unless they expire, unfortunately, right? But it's great to have. It's a step above, the GoFundMe. So it's a step above the GoFundMe, but it gives you that peace of mind that at least you're taken care of if something was to happen to you and you cannot afford a permanent policy. So it's who it's for, right? Everybody has a different situation. Depending on your financial situation will determine which one you should, consider. Whole life, on the other hand, it'll get you somewhere between 3 and 5% fixed income, in terms of how it grows, not income, excuse me. Cash value growth is what I meant, crediting. All right. It's for the whole life. And then universal life policies, approximately 6% is what you're going to have. But you're going to have to end up paying for the riders. You're going to have to end up paying for the riders for whole life as well. When I say riders, I'm talking about benefits. Riders is synonymous with the word benefits. So in an index universal life, it comes with those benefits. It's like the Mercedes-Benz of policies. It comes with a lot of benefits, right? The variable universal life policy is if you're having a retirement account, you're going to lose money you can lose money in a variable universal life. It is variable for that reason. Remember, we talked about in the very beginning how your money is structured. So you can lose money in a variable universal life policy, although some people like it because they're all about the risk. That's how they live, and that's how they want their money to work for them. The bigger the risk, the bigger the reward. But you got to also understand, is that money that you can afford to lose for your retirement, right? So just keeping that in mind. The index universal life permanent death benefit policy that you don't have to die to use. People love it because here's how they use it. Like I talked about in the beginning, how to position your money so that you can become the bank and that you have that infinite tax-free income. If you're going to become the bank, you can become the bank in an IUL or a whole life policy, ideally, because what's happening is as your money is building up a cash value inside this account, let's say you want to go out and start your business so that you can have another stream of income for retirement, rather that's Airbnb, Turo, real estate investing, whatever. That money that's inside the index universal life policy, whole life policy, you can access, take it out, use it as a loan, okay? For the first 12 months, you have an interest-free loan. There's no interest to have to pay on that. After 12 months, it's about 5 to 5.5%, depending on which carrier you're with. So if your investment opportunity can do at least greater than 5 and 5.5%, you may want to consider that as an option to fund your own business, expansion or whatever it is that you're trying to do. So the IUL is ideal for people that are looking to, use that cash value later in life to be able to do whether it's lifetime income benefit rider to live off of, or they just want to use that money to, say, pay off a house or whatever they want to do with that money. That is their money. If they don't pay the money back before they expire, the money just is subtracted from the death benefit. The beneficiary is subtracted or minus whatever the loan was that they took out of that policy. So it's kind of like having a loan that you never have to pay back, especially if you're someone that's single, don't have anybody as a beneficiary. You just kind of want to use this as something, as a tool, as a financial vehicle while you're living. It's very ideal for things like of that nature. You can use it while you're living. Your charity that you leave the money to, they'll just be subtracted whatever your loan amount is, right? Now, these are some of the other reasons why. If you have, say, an elderly parent, people use this because they don't want the parent to become a financial burden on them. If they have to go into a nursing home or something of that nature where they have chronic critical terminal illness, they can access their IUL death benefit and they can start using that money so that they don't deplete their funds, because 69% of bankruptcies are caused by medical illnesses that people don't plan for, because nobody plans to get sick. Nobody plans to have those types of medical challenges, but unfortunately it does happen. Cancer, heart attack, stroke, dementia, Alzheimer's, the list goes on. They can access the death benefit up to 100%, depending on the carrier, and be able to pay those medical bills off. Again, a policy that you do not have to die to use. Now, cash value, we already talked about that, tax-free loans. Here's what I want to tell you about the cash value, because there's two things that can get you in trouble. Because here's the deal. Unlike what you're doing with your traditional retirement account, where you have a limit of money that you can put in every year, people use IUL because they want to stuff a whole lot of money. That's why we have to do anti-money laundering classes, because people are money laundering inside policies. The number one place people do it because they want to stuff a lot of money in there so they don't have to pay taxes. They don't have to worry about, having, anybody come for the money in terms of the lawsuit of any kind. So the IUL is the number one vehicle rich people put their money in, because they want to make sure that they can have access to their money when they need it and nobody else can, not even the IRS. But the thing about it is, you are going to create a taxable event if you go above the modified endowment contract limit, the MEC, modified endowment contract limit. IRS code 7702 for the note takers, which are the money makers. IRS code 7702 says that you can put up to the MEC limit before it becomes a taxable event. You have to know that when you purchase the policy, so you know how much money you should, what's your limit, right? So with your normal, retirement accounts, the limit is the limit every year, right? 6,000, 7,000 if you over, so it depends. but you're very limited. And that is one of the other reasons why people use IULs for their retirement accounts, because they want to have a significant amount of money in there for tax-free income. The other way that you can create a taxable event is if you are not taking out loans, you're taking out withdrawals, trying to beat the system. You're going to send off a red flag to the IRS that says this person is taking all these withdrawals out, and they're not taking out a loan, they're not paying back interest, and then it's going to create a taxable event for you. So those are two reasons that the IUL could gain a bad name if the person didn't understand that and they did those things. Now, the better carriers are really not going to allow you, because I paid up to my MEC limit. I knew what I was doing, but they will send you a letter because they don't want you. The better carriers will not allow you to put more. They're going to send you a refund, or they're going to send you a letter or something that says you go at your MEC limit. If you put another penny in here, you're going to create a taxable event. So it's super important to understand that, so that you can not abuse your policy and send a red flag to the IRS. Lifetime income, you can know going into your policy how much money you have to put away to get to a certain dollar amount for retirement. For example, I had a young lady, she's 42 years old. She said, I want to have $50,000 by the time I am 60 years old coming in. So we designed a plan for her. You have to know, you have to begin with the end in mind. How much money do you want to have at what specific age? The illustration can be built based off of that. There's two ways that you can build an illustration for a client. You can build it as what's called a level, where it's the same death benefit their entire life, or you can do what's called a B increasing. The B increasing is going to give you less death benefit. It's going to give you more cash value. So if your dime, it's DIME, which is the amount of death benefit that you're going to have for your family, if you're married. Dime stands for D for debt. How much debt are you in total? I is for income. How many years of income do you want to leave them? 5 years, 10 years, 20 years. The M is for mortgage. Do you have a mortgage left? How much is that? And then the E is for education of your children, $100,000 per child. Once you add all those up in your dime method, that's going to give you what your death benefit should be. If your death benefit should be $1 million and you're trying to get cash value, so you're going to create a $400,000 death benefit, your family is not going to be taken care of. So you get hit by a bus tomorrow, right? That's not going to be fair to your family. You're going to leave them in a lot of debt. So you wouldn't want to be increasing in that situation. You might want to do a level, start off with $1 million policy. Some people have multiple policies. It is possible. You can have a policy for your retirement. You can also have a policy for your banking, meaning that you're going to structure the policy differently, or you're going to get a whole life so that you can have more money because you want to pay off debt. People can get in all types of debt, rather student loans or whatever. There's something called a debt policy where you can have a whole life, and now you get out of debt before you start getting into your retirement phase, because you're starting to pay that stuff off before you retire. You're starting to downgrade your lifestyle. You're not trying to live above your means. You're starting to be real frugal. A whole life policy will give you cash value faster in the beginning years, but long term it will not grow as fast as an IUL. I'll say that again. A whole life policy can give you more cash value in the beginning years so you can pay off your debt, but long term it will not grow as much as an IUL. So it's about how urgent, desperate you are for cash today versus later on. That's how you determine how to structure your policy for your retirement and for your income. All right. So let's keep going. No losses. We already talked about that a lot. And of course, you can do what's called a 1 to 3% minimum guarantee, meaning that typically an IUL floor is going to be 0, meaning you can't lose a penny, but you can pay a little extra and say, I want to at least get 1 to 3%, but you're going to have a higher premium if you do that. Okay. And so, speaking of that, there's all types of riders that you can attach. Today's is more about retirement. So we're trying to focus on just a retirement type of riders, which is the lifetime income benefit rider, which is the one that we've been talking about for the purpose of today. So that is all I have for today for now. I could keep going, but I want to stick to the meat of the matter. Let me see how I could get out of here so I can see you guys. All right, I can see you guys, and I guess I can take that out. How do I take this out of the show? 1 second. All right, perfect. I know that was a lot. I try to go through it as quickly as possible so that I could cover everything.
It was good.
Yeah, it was really good. Okay. So like me, I'm getting ready to, okay. I'm gonna take some, based on my notes, and I'm gonna rewatch this because I did have some things I wanted to make sure I was present. But if people say like, okay, I have questions, or I want to learn more about this, how can they contact you, or what are some resources
Sure.
that you suggest?
Sure, absolutely. And I actually have a retirement planning guide. If you go to shatikahustler.com, I'm not sure if you can put the ticker at the bottom. shatikahustler.com. This is my full name that's on there. I don't even see my name right now on.
Yep, we see it. Yeah.
Okay. So yeah, if you can go Shatika Hustler, I see it now. shatikahustler.com. They can actually download a retirement planning guide that'll help them at least start getting to take action on what is they need to take action on. They can also go there to, book a consult if they want to ask questions. And right now we are doing complimentary, consultations. It's June of 2022. And that's what we're doing right now for the rest of this month for sure. So, because that may be going away shortly because we're doing some other things. But right now for June, we definitely are doing consultations complimentary.
Perfect.
I think if anybody is interested in really making sure that you're positioning yourself, because like you mentioned, like I said, you gave a great presentation, and we all have heard Social Security is not going to cut it.
Yeah.
It's not going to be around. You're not going to make it with just that. So it's important to get connected with people like Shatika who can help you figure out what are your best options, right? What can you do to position your money so that you and your loved ones are in a better position? As her slogan is, how to retire before you expire.
I love that.
And there's a 1-minute story to that. I lost my two friends in 2018 to the flu. They both were young, 46 years old and 50 years old. They never really lived. They worked all their life. One was an entrepreneur. She worked from sun up to sundown. The other one was an executive HR, worked a lot of hours, had a single parent with an autism child at the age of 13. And they both expired. So when I say retire before you expire, like literally live your life, like move into your calling, like get into motion, because the tax code is written for the business owner. It's not written for the W-2 employer. So if I can get you to start positioning your money to at least go towards your business, you can keep more of it. So that's more money you have to play with for retirement. That is what people are doing now. That's why you see everybody is an entrepreneur, because they understand that the tax code is written for the business. Listen, it used to be 475 deductions before COVID, and now it's over 650 deductions. So people are absolutely taking advantage of that.
Wow. Okay. Well, again, this has been, as someone who does have a broker dealer background, I definitely understood a lot of what you were saying, but some of it I was hearing for the first time. So I really, really appreciate you for coming and giving us that presentation. And, we here at Curated Legacies, typically we try to stick within the 30 minutes, but when we were doing our planning session, we said, look, this is so important that we want to make sure that you get this information out today. So, I mean, that is it. Thank you everyone for tuning in today. Thank you so much again, Shatika, for joining us today. And we would love for those of you who are tuning in to join us again next week. We will be back here the same time, the same place on Thursday. And also, if this is your first time joining us, then we definitely invite you back to check out episodes 1 through 9, and feel free to let us know your thoughts in the comments. RJ?
Yeah, Shatika, again, thank you so much for giving this information, especially with the climate that we're in right now, right? A lot of people are feeling lost. They're uncertain because we're going through some uncharted territories right now. So, yeah, we really appreciate it. So we will see you guys same time next week.
Yep, we'll be
Have a good one.
Thank you guys for having me. My pleasure.
Of course. Thank you.